Chalo, good evening, good evening. So today is the first lecture. Let's start with the topic. Here, we are dealing in exchange rates and forex business. That is the basic first topic. Exchange rates and forex business. Okay. So now what is exchange basically? What do you mean by exchange? Exchange means foreign exchange. Means what? Whenever I am dealing in more than one currency, then it is called as foreign exchange. Suppose if I am dealing in only one currency, then will it be called as forex? For example, suppose hold on. Yeah, there's some camera adjustment to be done. Hold on. Let me see. Hold on. Just give me 1 minute. Huh? There's some camera adjustment pending. Hold on. Let me see. Hmm. Yeah. So yeah, actually, what happened? There was a camera problem going on. That's why I just had some issues. Chalo. Yeah. See this. Yeah. So every all of you are new over here. Okay. Sure. What my style is, I generally my first job is I'll give you the details of how will I teach basically. I'll be sharing 2 to 3 important PDFs with you. Those PDFs will contain the theory questions. Means there'll be a question bank. Then secondly, there'll be definitions and important definitions and keywords because majority of the questions are asked means almost 15 to 20 questions are asked from those PDFs. And don't do anything else. Okay. So these 3 PDFs and the lectures, that's enough for you for clearing your BFM. Mind it, don't take BFM lightly. You ask all your seniors, all your friends, whoever have done this BFM. Okay. You'll find that the BFM is the toughest topic in your CAIIB. Toughest topic. Okay. So that's why don't take it lightly. Because once this module A and module B starts taking the grip, it becomes very tough. Okay. Module C and D is okay. Once you are thorough with module A and B, C and D is okay. Okay. So let's start here. What is Forex basically? Forex is suppose if you are dealing in let's say two currencies. Okay. Dollar versus rupees. Suppose if you are dealing in dollar versus rupees. So if you are dealing in that, then you'll have the problem of forex. If there is an exchange between any two currencies, then only we have the problem. If I'm dealing only in rupees, no dollars, only in rupees, then the exchange doesn't matter at all, right? It's like suppose if I'm having, let's say, I'll give you a simple example. Suppose if I'm having my own field, my own agricultural field, okay, and I'm growing all my crops over there. So whatever is the rate of the crops in the market, I don't care because I'm getting the crops from my own field, right? Similarly, the same logic goes over here. The problem comes when I have to exchange the money. So the dollar exchange picture will come in when I have to exchange the money. Okay. Other than that, it won't come at all. Yeah. So foreign exchange comes when We are dealing with either foreign exchange or conversion of that foreign exchange, means some other currency or conversion of that other currency. Only then foreign exchange comes in picture. And that is actually called as foreign exchange. Now, these foreign exchange, we see these dollar rates generally going up, going down, 80, 85, 83. Yeah, day before yesterday, it was something 83, 80 to 83. Earlier, few years back, it was around 60s, but now it has gone to higher amount. Why? What is the basic reason for changes? There are two reasons basically. One is fundamental and second is technical. Fundamental means long-term reason, long-term, very long-term. Means, for example, country's balance of payment. Now, what is balance of payment? That is also to be understood. Balance of payment and balance of trade are two important factors in any country's payment system or any country's economy. These two are very important, balance of payment and balance of trade. So, what is balance of payment and what is balance of trade? Okay, let me explain it to you. Let me bring in one plain slide over here. Hold on. Let me bring in one slide. Give me 1 minute, okay? Yeah. See, this is a so balance of payment means what? Remember, there are two things: BOP and BOT, balance of trade. Trade means what? Trade means basically import or export. Whatever I do the import or whatever I do the export. Okay, so basically I'm meaning my meaning is over here is business. So whatever I do as a business will come under this balance of trade. Okay, so what happens over here? Balance of, suppose if I'm doing, it's similar to that of this current accounts here. What do we have? Current account and savings account in a bank, right? So BOP is similar to savings account, BOT is similar to current account. Now whatever is my bill, import export, that will come under this BOT. But what will come under this BOP then? Which is not a business part. Not a business part means what? It will be some NRI transferring the funds, NRI, sending the funds to India. Okay, so that will come under this BOP. Suppose there is a foreign investment, FII. So that will again come under this BOP. FDI, that will come under this BOP. Okay, so any type of funds or ECB, external commercial borrowing, that will also come under this BOP. So any type of borrowing or any type of money which is not a business, where I have not shared, goods are not shared. Okay, there is no exchange. So that will come under BOP. Now, one important point about this is BOT, whatever is the net, suppose if I am having exports of 100 and import of, let's say, import of 70. Okay, import 70 and export of 100, export 100. So my net will be what? 30. So this 30, where will it go? Once at the year end, let's say on March 31st, I am having exports of $100 and import of $70. So this 30 is the difference. Where will this $30 go? This $30 will be transferred to BOP. So always remember, the net of BOT, net of BOT is always transferred to BOP. Always. Okay. So this is the basic. You must always know this. Balance of trade will ultimately be transferred to balance of payment. Okay. So let's move on then. This much is enough for your means knowledge as such over here. Otherwise, here BOT and BOP are two big topics. We are not doing a PhD or doctorate on this BOT or BOP. Our target is to clear the exams, right? So generally surplus leads to stronger currency, whereas deficit leads to weaker currency. Quite logical. Surplus leads to stronger currency means what? If I'm having more incoming of dollars are coming in more, 100. Okay, and going out dollars are less, let's say 50. Then I'm in surplus. My country is stronger. Why are dollars coming in more? Because my country is growing. That's why everyone is investing, right? So that's why balance of payment, whenever there are more dollars coming in, then my country will be stronger. And in effect, what will happen? My currency will grow stronger. Always remember, currency of that country which has larger dollar exchange, okay, that currency goes stronger. Stronger means what? What do you mean by stronger? Okay, let me ask you this question again. Suppose if now my dollar goes $1 equals to, let's say, 60 rupees. And now after 1 year, let's say $1 equals to 80 rupees after 1 year. Okay. This is after 1 year. So what do you say now? Which has grown stronger? Dollar has become stronger or rupee has become stronger? What do you guys say? Which one has become stronger? Dollar has become stronger or rupee has become stronger? What do you say? Right? Dollar has become stronger. Very good. Dollar has become stronger. Those who are on YouTube, you can also answer. Kindly answer this on YouTube also. Those who are watching this video, okay, free demo class, kindly answer you also. So who has become stronger? Of course, dollar has become stronger. Rupee has become weaker. Now, if my balance of payment increases, means I am having more dollars. So there will be more supply of dollars. So if there is more supply of dollars, there will be lesser demand of dollars. So in that case, dollar will become weaker. So this 60, if I'm having more supply of dollars, after 1 year, this won't be 60, this will be 40. Because my rupee will get stronger. So if I have more balance of payment, my rupee becomes stronger. So my amount goes down. As the amount goes from 60 to 40, 40 to 20, so my rupee has become stronger. And this happens only when my country is stronger. The exports of my country are stronger. BOT is stronger. There are more NRIs of my country. See here, main NRI is also one of the important component who transfers the money to India. So if I have more NRIs in other countries, so they will transfer more money. So there will be more dollar with me. If my country is growing, then there will be more FDI. There will be more FII, foreign institutional investment, right? So in that case also my dollar becomes stronger, isn't it? My rupee becomes stronger, right? Economic growth rate. So now this again leads to, all these are somewhere related to each other. If you see all the reasons over here, they are somewhere related to each other. Balance of payment, economic growth rate, fiscal policy, monetary policy, these are all related. If my economic growth rate is more, it means what? My country is growing at a higher GDP. What is the present GDP of India? Around 6.5%, somewhere here and there, 0.25 here, 0.25 there. But if you look at this, even at 6%, it is much better than all the countries in the world. So that's why if any of the foreign institutional investor wants to invest, he wants to get returns, he or she, that FII will definitely try to invest in that country which will give them higher returns and safe funds. See here, higher returns is not the only case. Safety is also important. If somebody tomorrow in Pakistan guarantees 10% rate of interest, will you invest? Because where is the safety? Tomorrow in Afghanistan, somebody promises you, yes, I'll give you 12% returns. Invest. Will you invest? No. Where is the safety? So safety plus returns, average returns and safety. These are the two important points. Okay. So economic growth rate. So India's growth rate is quite robust, and that's why what is happening. Many of the foreign institutional investors are investing in India. We have this present dollar reserves right now. If you check, yesterday I checked it. It was 6 billion, 600 billion. It has grown again. It had gone down 450. Now it is again 650, 600. So that's why we are growing again. So economic growth rate, high growth rate leads to rise in imports and fall in the currency, fall in the value of that currency. So high growth rate means what? This is a temporary phase. Always remember, this is for the temporary period only. If I'm having high growth rate, I'll need more machineries. For that, I'll need to import more machines from outside, more this oil from outside. So that's why in the short run, it will lead to fall in the currency of my rupee. So it will lead to my rupee going from 80 to 85. But as the period continues, my machines start producing the goods. So those machines will give higher exports. In that case, in the long run, it will always lead to a stronger currency. Fiscal policy and expansionary policy. Now look at this. There are two policies over here. One is fiscal and second is monetary. Now what is this fiscal and what is this monetary? Always remember one simple logic. which is an important policy. Always, all the bankers have two things in their mind. We always think that RBI is the most important thing institution in the world. It's not that. Okay, always remember, it's nothing like that. Main important is always government. Government of any country is the most important element, and more than that, people are important because people have chosen the government. And RBI will always support government. Remember, RBI will always support the government. RBI in itself has no value as such. If there is no government, RBI has no value. Okay, so fiscal policy is always given by the government. Fiscal, and RBI always gives you the monetary policy. Monetary. Okay. So always remember, fiscal means what? Financial. FIS means financial. Okay. And year, we call it fiscal means what? Financial year. Okay. So this policy is always related to the common public. So government will always form this fiscal policy first, and RBI will support it through its monetary policy to the government. Means, for example, I'll give you. Suppose if government wants expansionary policy. What do you mean by expansionary policy? In fiscal, look at this. Now I'll give you both the examples. Expansionary policy. Let's say in government, fiscal policy. So what does it mean? Government wants to expand. Expand means what? It wants to produce more. So how will it produce more? For producing more, it will do one thing. What does government have in their hands? Government has tax. So it will put less tax on all the types. So tax can be indirect tax, GST tax can be direct tax, like the income tax which we pay. Okay, so it will put less tax. So this is known as expansionary. And if RBI, now what does RBI do? RBI will always support the government. So government wants expansionary, RBI will also make it expansionary. So how will RBI expand? RBI doesn't have tax in their hands. So what does RBI have in their hands? RBI has CRR, SLR, and repo in their hands. Main three tools which RBI has. So what will it do? It will try to bring them down. So once it brings them down, again it becomes an expansion. More money flows into the economy. So people have more money. There will be more expansion. So always remember, RBI will always support, monetary policy will always support the fiscal policy. Fiscal policy is always long term, long. It will always think long term. Monetary policy will always think short term. That's why what do we have? We have budget. Okay, a very simple example. Government budget. It comes once in a year. Once in a year. Okay, once in a year. Okay. So fiscal policy, it's related to fiscal government. Monetary policy, how many times does it come? Every 2 months. So 6 times in a year. 6 times in a year. What do you mean by this? This is always short term. RBI's monetary policy is always short term, whereas government fiscal policy will always be long term. RBI is always there to support the government. It doesn't have its own existence without the government. Always remember this. Okay? Yeah. Interest rate down. Correct. Okay. Next one. Hold on. Yeah. Chalo. Next one now. Let's move on. Interest rates. High domestic interest rates tend to attract overseas capital. Thus, currency appreciates in the short term. Now, I'll give you a simple example for this. High interest rates. Anyone is tracking this world economy going on, what is going on in the world? If you look after that Russia-Ukraine war last year, you see the what this US Federal Reserve has done. What is Federal Reserve? Federal Reserve of US is same as RBI of India. Okay. So what has Fed Reserve done? Fed Reserve had gone on increasing the interest rates, going up. Why? Because the inflation in US had gone up from 3% to almost 9 to 10% last year. If you check the inflation rates right now, also you can check it on Google. You check the inflation chart. It had gone to 9 to 10%. And because of that, what happens? If the interest rate goes up, government always try to control that. How does it control it? It will control it by increasing the interest rates. What interest rates? Here, I means Federal Reserve. I'm talking of bank, Reserve Bank. So Fed Reserve of theirs will always try to increase the repo rates, increase the CRR, and SLR lately means SLR is always the last tool. Main are these two tools. Okay, because SLR is always long term. So it will try to increase the CRR and repo first. So as they tend to increase the these rates, what happens? There's a effect of this. What is the effect of this? As the rates go up, look at this. Whatever I'm drawing now, as the rates go up, okay, what all things happen? Just look at this. Huh? It'll give you a complete picture of the economy. What happens as the rates go up? Inflation goes down. Means महंगाई, inflation. We always got that महंगाई मार गई, right? There was a song earlier, right? So inflation will go down. So if inflation goes down, that is point number one. Second thing, the dollar rate means currency. Now here we are talking of US. So if US interest rate goes up, their dollar goes up. So that's why if you see in last year, the dollar rate has increased from almost 75 to now it is 83. Why is it increased? Because the US has increased the rates. As the US rates goes down now again they are coming down. US has brought this rate, it had taken to around 4.55. Now it has brought down to around again lowering it down. So once these rates again go down, the dollar rates will again go down. So the logic over here relates to your BFM class. What does it say? High domestic interest rate tends to attract overseas capital. Thus, currency appreciates in the short term. See this, currency is appreciating. In the however, higher interest rates slow down the economy. See this. So as the rates go up, inflation will be down. So that is a good thing. So I'll write it over here. Rates good. Dollar goes up, good for US. I'm talking in terms of US only. So good, but there's a negative effect also. My GDP goes down. GDP will go down as my interest rate increase. So that is bad. Okay, and that in turn will lead to the poverty again. If my GDP is going down, there will be less of production. So it will lead to more of the poverty in the country. So these are the main four effects or three effects of any rates going up. And reverse is the case. If you go bring the rates down, whatever is down over here will go up, whatever is up over here will go down. Simple. Next is this political issues. Political issues, you all are aware of this. Afghanistan. Suppose if I tell you to invest in Afghanistan, will you invest? No. I tell you to invest in, let's say, China. Will you invest? No. Why? Because China, you'll say, sir, growing economy. Look at the communism, okay? It's after all the command economy. If I tell you to invest in North Korea, will you invest? No, right? Why don't you invest? Because there is a command economy. We can't work in the command economy. In India, we have the capitalist economy. Capitalist means what? It's a free and fair democracy. So that's why any country which is having the democracy will always tend to be a brighter spot. But not only democracy, it should have the growth also. Otherwise, only democracy and no growth, that's of no use. No, the world always salutes the one who is growing. Very simple term. Okay. So political stability is likely to lead the economic stability and hence steady currency, while the political instability would give the opposite effect. Right? Instability means what and stability means what? See here, there's a special analysis called as pestle analysis. What is pestle? Political. Should I write it over here? Okay, let me write it. Political. Then economic. Then what? Social. Social means how are the common public over there? Then technological. Tech. Environmental. Now this is very important part. Earlier this was not an important part, but now environment has become a very important part in the economy. Okay. And last one is legal. So these are the six elements which are always to be checked while investing in any country. Political means how is the political stability over there? Is there a democracy or is there an autocracy? If there's the autocracy, how is the king over there? Okay. Economic means how is the economy growing? GDP growth rate. What is the inflation rate? Social, how are the people over there? What is the culture? Are they working public? Do they like to work? That is also very important part. Do they like to work? Okay. Technological, what is the technological advancement of this country? What is the penetration of machines in banking system? See here, every country's investment means overall scenario is from the financial field. If the finance field is strong, your country will always grow strong. Okay. Take then next is environmental. Do you adhere or stick to the environmental laws? If you are not sticking, then the world will boycott you in some years. So that is also an important part. Legal. Legal means I'll tell you one simple example of legal. Very simple example. Legal, if you say, suppose, what is our check? Means this check which we give. How many months this check is valid in our country? How many months the check is valid in our country? Everyone, just answer me. How many months the check is valid? Right? 3 months? 3 months? Everyone 3 months? Okay, done. 3 months. Okay, done. Okay, yeah, everyone is answering. Good. It's always a good sign. If you answer, even the one who is teaching you will understand that you all are attentive. So 3 months is the answer over here. Now I'll ask you one more question. What is the validity of checks in Dubai? Like we have 3 months. What is the same period for Dubai? Do you know? Some of you might have dealt with Dubai or foreign exchanges. You might know it. In Dubai, the checks are valid for 2 years. 2 years, roughly, plus or minus 2 years, 2.5 sometimes. Okay. Dubai, it is 2 years. Now, this is known as a legal term. Legal term means what? It's very difficult in legal term, right? Suppose if I take the same law of India and use it in Dubai, so it won't be of any use because there the rules are totally different. So that is known as a legal. There can be many examples. I'm having thousands of examples in this. Means suppose if some bank takes a security over here in India, so you can take it as a security, means collateral security. And suppose if that person doesn't pay, you have SURFACE Act. You can definitely take that property and sell it. But in many countries, it's not the rule. So that's why if we have to invest in that country, we have to first look at the legal part of that. What does the legal structure says? Okay. So these are all the fundamental problems. There are technical reasons also. What are the technical? These are all short-term reasons. Here, fundamental will always be long-term. Growth of that country, GDP, foreign investment, all these are long-term reasons. Short-term means what? Abhi kya abhi? Abhi kya abhi means what? Just now. So always I'll tell you, okay, one basic reason I'll tell you. Suppose if you go and purchase a plot today, if you want to purchase the plot today, a flat plot, anything, second-hand flat you want to purchase, or you want to buy this plot from somebody, means plot means that property. We always use the broker. Generally, we use the broker, right? Because we don't have time. So broker is used. So the rates of that property are mainly, many a times, decided by that broker. Always remember this. The broker tells you, sir, this is the rate. This is the rate over there. That is the rate over there. And you believe in that. So always middle persons over there will be known as the speculative forces. So these speculative forces will always govern the rates in the short run. Always. Okay. So what are the main reasons? One is speculative forces, which have the major effect. This has almost 75% of the effect in the short run. Okay. Second is this capital trends. Capital. This capital will always grow from lower yielding to higher yielding. What do you mean by this? Lower growth to higher growth means what? Let's go further. Here we always should ask the question is what or how. At least 5 times you must ask the same questions. Lower yielding means what? Suppose if I ask you what do you mean by this? So again, yielding means what? What do you mean by yield? Yield means the returns which I am getting. Returns means what? Whatever I invested, suppose if I have invested rupees 100 in anything and I'm getting after the year, I'm getting let's say 11 rupees. So my yield is what? 11%. 11 rupees on 100. Okay, so that is my yield. So lower yielding to higher yielding. So if India is growing at 6.5% GDP, 6.5%, and US is growing at say like right now it's growing at around 0.5 or even negative. At 0.5 I'm talking too much. It's going at 0.25%. So if I am the investor over here, what will I think? Should I invest in US or should I invest in this US in India? Definitely money will flow from US to India. That's why we are seeing so much of the foreign funds in India. because we are growing at this rate. Okay, so capital always tends to flow from lower yielding to higher yielding. And last one is this government controls. Government will always, in the short run, government will be always the least control part over here. Long run, it is a major portion, but short run, it is always the least part. Can lead to unrealistic value of the currency, resulting in violent exchange rates. Means what? Like this, see this. Government controls are mainly in command economy. Command means what? China is a communist economy, it's a command economy. In command economy, what happens? Government, whenever wants, it can reduce the rates of the currency whenever they want. If you check 4 years back, four, not four, 5, 6 years back, you just check the Google. Yuan is a currency of China, right? Yuan is a currency of China. You just check once. In 6 years back, there was some news. That news was at in one night, today evening, Chinese government decided they will devalue their yuan. Devalue means they brought down the rate of yuan by 7% in one night immediately. So this is the main effect of government controls, command economy. India can't do this. If Indian government tomorrow decides that we'll bring down the dollar rate from 80 to 100, it can do it. Why? Because we have a capitalist economy. The government, the dollar rates and the rupee rates over here are not driven by the government. They are not controlled by the government. They are controlled by the complete market economy, demand and supply. Whereas in China, it is controlled by the government. That is very bad. Always. People know, suppose if you want to invest, will you invest in these countries where government controls everything? No, isn't it? So that's why. So these are the short-term reasons. Government controls, lower yielding to higher yielding, speculative forces. Okay. Now let me ask you some questions. Although I'll give you the answers immediately. The term foreign exchange is used to denote, now this is a test for you. The term foreign exchange is used to denote dash as well as the dash of one currency into another. So the term foreign currency is used to denote what? How will it means? What will it actually give? Foreign exchange is used to denote what? It used to denote what? Currency. Simple. It will give me the currency, whatever currency I'm dealing in, for dollar, this pound, whatever it is. It will be this, or as well as the dash of one currency into another. Now this you should be able to answer. The dash of one currency into another. So what is this dash? Return and yield are same. Nithu. Return and yield are same. Okay. We will see this more and more. Because we are having this topic Neetu again. What do you mean by return? What do you mean by this yield? Okay. So yeah, exchange of one currency into another, conversion of one currency into another, both don't mean one and the same. It can be conversion or it can be exchange. Okay, exchange, anything one and the same. Main logic is one currency changed with another. Okay. So that is the second answer. The exchange rates of major currencies fluctuate every dash seconds. My God, what is this? Now, this is one important thing. Many of you might know or may not know, every 4 seconds, okay, the exchange rates of major currencies change. Mean dollar rates right now, if I'm speaking something, after 4 seconds, it will be different. Okay, why? Because the currency is so liquid. Everyone wants dollar. Okay, so that's why of the major fluctuating currencies, it changes every 4 seconds. And remember, this forex market is never sleeping. It will never sleep. Forex market will be on each and every time. Every second, 24 hours a day, this forex market will be on. So that's why even if you sleep at night with dollar at 80 rupees, in the morning you can get up at $89. 9 rupees can be the change if something happens drastically. Okay. Next one. Let's see true or false. Yeah. The forex market are dynamic and round the clock markets. True or false? Very simple. Let me see. First one. The forex markets are dynamic and round the clock markets. True or false? Isn't it? Simple one. Correct? True. Yes. Guru, you are right. What you have said on YouTube also. Guru S. Dollar becomes stronger over there. Correct. True. Right. Second one. The forex markets are not affected by government policies. Is it so? Second one. Now I want the second one. Second answer. Second one. Huh? The forex markets are not affected by the government policies. Is it so? Forex market will be definitely affected, isn't it? It is false, isn't it? False. This is true, right? A large part of total global forex turnover results from global commodities market. Commodity means what? Oil. Main commodity in this world is oil. Okay, everywhere. See here, what does India import? Okay, let me come to this point. In India's balance sheet, we always have major imports. What are the major imports? One is, who can tell me? What are the major imports in Indian economy? What are the major imports in Indian economy? Okay, let me answer. Get this oil. Okay, one is oil. Okay, oil. Second, now I'll give you some surprises. What is the second one which we import? Gold, right? Viresh, very good. Gold. Gold is the second one. Third, in order. First is this, second is gold, and this is in order. Now third one is what? Third one is very difficult. We always know oil and gold, everyone knows. But third one is the most difficult thing. No, crude is first. Crude oil is first. Here, I'll write it over here. Crude. This is crude. Crude is the first one. Third one is also oil. But which oil? Here we are importing edible oil, palm oil. Very worst thing in the world. India as a country, coal is there, but palm oil is one of the important elements of our imports. Very, very serious problem in India. Arms are there. Arms is totally separate. See, our defense budget is kept as separate totally. We shouldn't mix defense budget with the civil budget. Okay. So edible oil is one of the important constituents of imports, and that's why India is now targeting why. Why is government focusing on these oil-related, edible oil-related issues? Because if we are able to reduce this edible oil, then also major portion of your import is gone. Even crude oil. Suppose if we are able to change to solar. Suppose if I am able to change to majorly to solar, so crude oil will be gone. So that is the main point. So large part of the total. Let's come to the question back. Okay. The large part of the total global forex turnover results from global commodities trade. Is it so? Commodities. Does my large part of the trade relate to global commodity? Global. I'm not talking of India. I'm talking of global. So globally, remember the answer is false. Commodities are just a short part of the trade. Total trade is this FII, FPI, foreign portfolio investment, FDI, foreign direct investment. Investments play a major part. Okay, rather than this commodities. Okay, so the answer is false over here. In India, it is true. If you talk only of India, then for India it is okay. But global, here, the question over here is global. So global means it is not true over here. Most of the forex deals are done on spot basis, meaning thereby that the delivery of funds takes place on the second working day. Now, these are something basics which you have already done in your CAIIB. But again, we'll revise this because CAIIB, we are such a mind that gone is gone, isn't it? So we don't remember what we ate yesterday. Suppose if I ask you, what did you eat yesterday? Many of you won't remember this also, right? Because we have so much pressurized in the banks. So that's why forget CAIIB. CAIIB was done 1 year back, right? Many of you will say, sir, 2 years back. Don't remember anything, isn't it? That is the case. So that's why we'll have to revise this. Okay. So what is this spot? There are 3 to 4 elements over here. One is cash ready. Cash ready, remember this cash ready is not a one word. It is either cash or ready. Both the things mean one and the same. Okay. So cash ready means it is same day. It's like this. Suppose if you go to any shop or purchasing anything, if you have cash, you'll always get it at a discount, right? Simple thing. If you have credit, udhari, then that person will raise the rate. That person will calculate the interest also, isn't it? Same thing happens over here. So cash ready means same day. Tom means next working day. Remember, working day. It's not next day. Suppose if I am working on Friday. Now let me ask you some questions over here. Okay. Suppose always remember Saturday and Sunday. Saturday and Sunday are holidays in forex market. Always holidays. Okay. So now if I ask you, that I'm working on Friday, okay, and I'm working on Tom. So what will be my date, settlement date? Friday, Tom. Settlement date will be Friday, Tom. Settlement date will be Monday, isn't it? Next working day, right? Similarly, second thing, okay, Monday. Good one. Suppose cash ready. Friday cash ready. So same Friday, same day because it is, right? Suppose I am working on spot, next to next working day. Now this is the second working day. Remember, books give you this word as second. So second means next to next. It's not the next. Okay. Second working day means next to next. So Friday and spot is what? Suppose if I'm working on Friday and my spot will be what? Monday over here. Then here it will be Tuesday. Right? Next forward. Suppose forward. So forward will be what? Anything after this. Remember this. Anything after this spot. Remember, anything after the spot means it can go from this second working day spot day to any day in future. It can go for 10 years also. It can go for 100 years also. So forward can be any day after the spot. And last one is this future. Future. What is the difference between future and forward? Both are actually one and the same. Okay. Both are actually one and the same. Then why two names? If both are same, then why two names? The two names because understand the difference. Okay. Suppose let's say I'm giving you a simple example. Future is known as the organized forward. What do you mean by organized forward? Okay. If you want to buy the shares, okay. Suppose let's say shares, stock market. You have to buy, let's say, shares. Okay. There are two ways of buying it. One is directly from NSC, NSC, BSC, right? NSC or BSC. Or second is, let's say we both are friends. I am your friend. I am having Reliance shares. I want to sell them, and you want to buy them. So what we can do? We can deal with each other also. You can tell me that you transfer the shares to my account, and I'll give you cash separately. So between two persons, me and you, A and B. Okay, it can be between A and B also. Right? Got it? So now what is the difference between these two transactions? Same is the transaction between forward and future. Let me take this example further. A and B. Suppose if I decide, you and me decide that the Reliance share presently, let's say, presently Reliance is quoting at around, let's say, 2500. I don't know the exact rate, but roughly, let's say it's quoting at 2500 plus or minus. Okay. So if we decide with each other that I will sell you the Reliance share at 2800 and we both agree to each other that 2800, who can stop me and who can stop you? If we decide to purchase at 2800, it's our wish. So that is known as OTC, over the counter. Here nobody is in between, only you and me. So this is known as forward. Forward is always OTC. Okay, nobody can stop you. But NSC, BSC, suppose if I have to purchase the share from NSC or BSC, if it is quoting at 2500, can I purchase at 2800? No. I'll be purchasing it at the spot market rate, whatever is going on in the market. Why? Why is this difference? Because while purchasing, see this is the diaphragm or this is a parda we call it, right? This is NSC or BSC. I am not talking of NSC, BSC. It's just exchange. This is A and this is B, right? These two AB are over here now. They don't see each other. So if A wants to purchase the Reliance shares and B wants to sell the Reliance shares, they don't see each other. So what happens? Whatever is going on rate in the market, A will purchase at that rate only. Why? Because there is a third person in between. So that's why this is called as organized. Organized means what? This third party, NSC, which comes in between, that gives the rules. The rules are given that, see, if you want to purchase the shares, purchase it at this present market rate only. If you want to sell the shares, sell it at the present market rate. No premium dealing. Nothing. So this is known as the setting the rules. So that's why future is called as the organized forward. Okay. In future, there will be always three parties: buyer, seller, and the middle person. In this forward, there will be only two parties: buyer and seller. They can decide their own rules. Okay. The date of delivery of funds on the date on which the exchange of currencies actually takes place is referred to as a value date. Okay. So this is known as a value date. Okay. Yeah, just hold on. Yeah, now you'll be able to see this. Is known as a value date, right? Yeah. Future is on specified. Even forward is on specified date. Forward and future both are on specified date. Only the difference is in future there is a third party involved. There is a rule making agency involved. Whereas in the forward rate, the rule making agency is not involved. It's between you and me. Okay. Next one. Forward rates are derived from the spot rates and a function of the spot rate, forward premium or discount of the currency being quoted. Means what? Keep it very simple. If you, um, let's say, one sec. Let me tell you one thing. Okay. Suppose if we deal with each other for buying a flat, let's say simple rule, flat. Because then only you'll understand it. Otherwise, this forex is very difficult part. If you want to buy a flat and I want to sell that flat, okay. Now what happens? You come to me, sir. I have to buy this flat. The rate is what? Let's say I'll say right now at 30 lakhs. The flat rate is 30 lakhs. Okay. So what do I say? Okay, see, my rate is 30 lakhs. So you'll say, sir, 30 lakhs? No, sir, very high. I'll tell you. See this. Right now it is 30 lakhs. Now, after 1 year, there is an airport coming nearby. There is a new airport coming. So this rate of 30 lakhs will go to around 50 lakhs. At that time, you'll have to buy at 50 lakhs. So right now I'm selling you at 30 lakhs. Buy it. After 1 year, it will be 50 lakhs because the airport is coming up. So what do you mean by this? This 30 lakhs is known as a spot. Spot. Okay. So this is the spot over here. This spot. And premium means what? Because the airport is coming near my flat. So that's why I'll be charging higher. So this 20 lakhs becomes my premium plus 20 lakhs. So then my total rate becomes 50 lakhs. So this is known as the premium. Right? Reverse thing can also be true. Suppose I buy today my flat is this much and there is a mining industry coming up, coal mine coming up near me. Okay, just besides my flat, there is a coal mine which is coming up. What will happen? Will you buy the flat in near that coal mine? Daily that sound of digging that coal and this dust, everything, you won't buy that flat. So what will happen? It will go reverse way. My flat will be I'll have to sell it at less, 10% loss, right? Discount. So my flat rate will be what? 30 minus 10, 20 lakhs. So this is known as discount. So always remember forward rates are derived from the spot rate and are the function of spot rate plus premium or discount. Means plus means if it is premium, it's plus. If it's discount, it's minus. It is quoted like this: spot plus premium or minus discount, whatever it is. Okay. Simple. Got it? Clear? Value spot can be the same. Value and spot. Future is on the specified date. Correct. Yeah. Spot day. Value date and spot day can be same. Yeah. Spot day means what? There's nothing called a spot day. Spot rate means today's rate only. And value date means suppose if I am dealing it today only, then it is cash rate. The value dates are only these four: cash ready, then Tom, then the spot and the forward. These are the value dates. Okay, means it can be anything. Suppose if I'm dealing in T plus 2, then it is value date becomes spot date. That is same then. Forward rates are a function of spot plus premium. Just now we discussed. Yeah. Now we'll come to some important part. Yeah. This example will clarify one more doubt in your mind. If the value of currency is more than being quoted in the spot, see this, huh? If the value of the currency is more than being quoted at the spot, then it is said to be in the premium. While if the currency is cheaper at a later date, then it is quoted at discount. Simple, isn't it? Same flat. Presently it's 30 lakhs. After 1 year it will go to 50 lakhs. Means what? It is quoted at more rate, right? So that's why it is at premium. And reverse thing is also true, right? So now look at this. Now you'll understand one main difference. I've taken two examples over here. One is of GBP. Yeah. GBP and INR. I've taken two examples. Now you'll understand some difference over here. If the spot GBP against USD is being quoted at 1.6. So GBP to USD, it is quoted as 1.6. And 1 month forward is quoted at 1.6050. Then GBP is dearer. What do you mean by this word dearer? Dearer means premium. Who is dear to you? Who is dear to you? Okay. Which son or daughter is dearer to the father and mother? After they grow up, obviously after they grow up. Which son or daughter is dearer to the father and mother after they grow up? Which son or daughter? The one who earns or one who doesn't earn? Simple logic, isn't it? Which son or daughter is dearer to the father or mother? Father and mother, you can say. Once they grow up, 30 years old, 25 years old, not working. Many of us might have experienced this, right? Even the father and mother scold you. इतना बड़ा हो गया, काम नहीं करता, this नहीं करता, काम पे जा, do this, do that, 1,000 things. So who is dearer? The one who earns. Simple, isn't it? That's life everywhere. Even in finance, even in practical life, same thing happens. The one who is dearer is always that person who earns. So here who will be dearer? The one who is having premium, isn't it? The one who is having premium will be dearer. And who will be the other person? Means non-dearer or so who will be non-dearer over here? So let me see. Yeah. So who will be non-dearer? Means dearer means the one who is having premium. So the point over here is if the spot against GBP against USD is quoted at 1.60 and 1 month forward it is 1.6050, then the GBP is dearer. Value of 1 month forward, a premium of 50 BPS is being charged for the same. So now if you look at the reverse case also for INR, look at this INR, okay? The spot GBP is quoted at 1.6000 against USD and 3 month forward is quoted at 1.5000. So what is happening over here now? Earlier GBP was 1.60. After 3 months it is 1.50. So GBP is at discount over here. The USD and other currency is at premium. So if one currency is at discount, the other currency will be at premium. Always remember, it's a game theory. One person's profit is other person's loss. Okay. Now Indian rupees, it's not true. Look at this. Indian rupee, let's say it's quoted at 48.70 and 69. This is the rate. Let's say, the 6 month premium is 68 and 58. So the 6 month rate after this will be, suppose if it means that USD being quoted dearer, forward is being quoted at 48.02. So what do you mean by this? Suppose 6 months premium is quoted at 68 and 58. So what do you mean by 68, 58? Whenever the right